Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And today I'm joined by Mac Shelton. Mac, welcome to the show.
Thanks for having me, Whitney.
Yeah, I'm looking forward to talking about today's deal, Landon Square and Briskwood Apartments, 41 units in Roanoke, Virginia. But before we dive into the deal, tell us a little bit about yourself, what your background is, and how you got into the multifamily space.
Sure. So I grew up in North Carolina. I spent most of my career before this actually in corporate private equity, so doing mergers and acquisitions for private equity firms. I bought my first rental property right out of school in Raleigh. It was a townhouse that I house hacked. And within a few months of buying that, I knew I wanted to do more. Spent probably the next year looking before I found the next one, which was a student rental in Columbia, South Carolina. I bought that in 2019 and ended up purchasing a few more over the next couple of years, along with my current business partner, Tucker Thompson, who bought a couple as well during that time. And those deals ultimately led us to buying a portfolio of those units in the same development from the founders of the development company that built them. We built a good relationship with that broker and got an off-market opportunity to buy those. And that was the first time that we raised LP capital for a deal. We closed that one in 2019, October of 2021, and exited in January, and actually 1031'd into the deal that we're talking about today, Landon and Briskwood. So that's sort of how I got into multifamily.
Awesome. Well, let's deep dive into this. Landon Square, Briskwood Apartments is the two buildings, a total of 41 units in Roanoke, Virginia. When did you close on the deal and what did you purchase it for?
So we closed on it February 10th of this year, 2023, and we paid $3.25 million.
Awesome. All right. Well, let's back up the timeline. When did you find it? Like, was it an off-market deal? Did you have a realtor? How much competition was there? Tell us the dirty details.
Sure. So this one was actually a listed deal. My business partner found it on Crexy in mid-October, and we don't find a lot of deals on Crexy today, but at the time we were just getting started really in this strategy, and that's where we found a lot of things. So it was listed on Crexy, and we submitted an LOI within about a week of finding it at $3.5 million actually, and ended up making some adjustments along the way, but that's how we got it signed up.
Okay, so you found it on Crexy. So was there much competition? I mean, how did what gave you the edge to get this under contract?
So there was definitely competition. I think there was less competition for this deal than for a lot of others we've bid on, mainly because it was a portfolio of two smaller properties as opposed to one larger one. And Roanoke there's not as much competition in Roanoke. At least they're starting to become more competitive, but there wasn't as much as there is in, a Raleigh or a Charlotte or Charleston. I think we were probably one of 5 to 10 bidders. And I remember the broker saying it was pretty close. I think we had one other group actually at the same price that we came in at. But ultimately they had to come with us.
Well, why is that?
I think it was because we'd already closed the deal and we'd proven we could raise the capital. I think a lot of people, especially in these smaller deal sizes, you get offers from people that may not have done that. And there may be questions about whether they actually can raise the capital for it. So I think that definitely helped.
Awesome. Well, let's talk about how did you structure the deal?
So we raised about $2 million of equity. 600 of that was from the 1031 from our first deal, which closed a couple of weeks before this one. And then the other 1.4 came from new investors. And then we had a loan for 1.8 million at close.
Awesome. So that's the capital stack, but let's talk about the purchase sale agreement. How did you structure that purchase sale agreement with the seller? Did you have 2 weeks due diligence, 30 days to close, a couple extensions? Was there any earnest money down on the deal?
Yes. So the due diligence and closing were both a little bit longer on this deal than they probably would otherwise have been, because we signed it up just before Thanksgiving. So we had to deal with Thanksgiving and Christmas and New Year's throughout the process. We signed a PSA on November 17th. We had a $50,000 earnest money deposit initially that got us a due diligence period of 35 days, ended the day before Christmas Eve. And then closing was supposed to be 26 days after that, so January 18th. We also had a 20-day extension option for another 50,000 that at that point would have been non-refundable because it would have passed the due diligence period.
Got it. Got it. So in the due diligence period, at what point did you tour the property? Did you tour it before you put it under contract, or like during your due diligence period?
We did both. So we actually did our initial tour before we submitted. I think it was actually right after we submitted the LOI, before we signed the purchase agreement. And our process typically is on that first tour, we want to make sure we see at least one of every floor plan. Ideally, it's good to see non-renovated and renovated units if they're already renovated units. This one really didn't have any. But on that first tour, we already have square footage and some details from pictures during our initial underwriting before we see it, but we use that tour to count the number of light fixtures and doors and things like that to be able to build a check sheet that we then use on our full unit walk to see what needs to be replaced and what can be left alone to go into our renovation budget. So we toured it, looked at a few units with the broker before going under contract, and then did a full walk of all the units with our property management company and some contractors. I think it was the week after Thanksgiving, so during due diligence.
Okay, so tell us a little bit about one, the business plan that you're eyeing for this asset, and then two, like due diligence.
Sure. So the business plan was, I mean, these properties were owned by a partnership, two older gentlemen that had owned them for 20 plus years and really they were focused on occupancy. Their cost basis was so low that they were making money without having to really push rents, and they didn't. And in a lot of cases, the rents were half of market. We had some tenants that had been there for a very long time without rent increases. And also, as a result of that, a lot of the units were not in great shape, right? A lot of them were cleaned up and they'd at least done new carpets and paint. It wasn't like they were neglecting the property, but if you've got a tenant in a unit for 10 years and you haven't changed the carpet or painted or anything, they can get pretty rough. So it was to go in and spend, our budget had about 17,000 a unit on average. There were 1 bedrooms all the way up to 3-bedroom townhomes. So that varied a lot by floor plan. But it was, floors, paint, lights, appliances, cabinets and countertops. And we also budgeted for some exterior CapEx at both properties. One of them is brick, so there wasn't as much to do there, but one of them was cedar siding that hadn't been painted in probably 15 years. So we went through and repaired all the old rotten pieces of siding and repainted it. And then that allowed us to raise rents, up to market. And in some cases, I think the market rents were higher because of the renovation. So our plan was to increase rents about 50%. And we're already pretty close to that now after about 6 months since close.
Awesome. Okay, so to sound that back, essentially you're looking at 41 units that, in some form or fashion, need to be updated, either just exterior or interior and exterior. So more of a value add strategy.
Right.
Now, knowing that there's some deferred, capital expenditure here, and then also potential deferred maintenance, it sounds like, with the exterior. How did that align with your due diligence when you did your walkthrough, the physical due diligence? Like, were there any surprises?
They're really, well, not in the units themselves. I mean, there were some surprises when we got, for example, an electrical inspection done. So one of the properties was built in 1985 and one was built in 1968. The one that was built in 1968 had a lot of electrical issues that needed to be addressed. We didn't plan on that when we initially submitted the LOI, but we got that inspection done during our due diligence. And I'm sure we'll get to the financing later, but due to our financing, we had to adjust the purchase price later on. And by the time we did that, we already, were able to account for any of the stuff that we found our due diligence, including that electrical work.
Got it. And did that electrical work impact your ability to get insurance?
No, it wasn't bad enough that it would have impacted the insurance. It was just more of we felt that, for the apartments to be safe and also for liability reasons, it needed to be done. But it wasn't something that impacted insurance. You
weren't like doing knob and tube wiring or anything like that?
No, it wasn't anything like that. It was mostly just, there were one big focus area of ours is always whether there's aluminum branch wiring. There wasn't aluminum branch wiring here in the units, but there was aluminum wiring going from the boxes to the property. And the way that those were tied into the rest of the systems, in some cases, they needed to be maintained. They needed antioxidizer on the, the joints and that sort of thing. And they just hadn't been kept up with. So it wasn't that, we had to redo the entire electrical system. It was more just catching up on deferred maintenance.
Got it. And let's talk about the financial due diligence. Were you able to, from this kind of mom and pop owner, able to get full financials, trailing 12? Like, how did that look?
We did get financials. They were definitely not perfect. We actually still have some units that haven't been turned over yet where, the rent roll that we were initially given doesn't line up with the leases we were given and things like that. But overall, the property was 100% occupied when we bought, when we put it under contract. They actually had one tenant leave the week before closing, but it was, fully occupied, and they really didn't have any major delinquency issues. So from that perspective, the financial due diligence was pretty simple. Most of the time we spent on underwriting and financial due diligence was related to the renovation budget and making sure that we had, we'd never done a deal in Roanoke before. So we wanted to make sure we had hard quotes to back up every number in our budget. And we spent a lot of time talking to different subcontractors in the area and getting quotes on those things before finalizing the numbers and sending out our investor deck and going, past the due diligence expiration date.
Got it. But no surprises as far as performance. How are you handling the essentially the wrong tenants or the incorrect tenants not matching up with like the leases? How are you handling that?
Yeah, so in a lot of cases, we do have the original leases, right? So we just go by whatever those say. If it doesn't line up with the rent roll, it hasn't been anything as serious as, a rent in the rent roll being much lower or higher than what's on the lease. It's usually just the dates are wrong, right? Like maybe somebody's lease end date is a month or two before or after the rent roll said. And it hasn't really changed our business plan at all, because we were able to just, do a lease audit, which we did during diligence with our property manager, and that cleaned that up.
Okay, so you had the right people in the right apartments. It's just that the details don't exactly line up.
Yeah.
Got it. Right. Okay. I was just like, how interesting. Like, how are you handling that? Well, let's talk about the financing on the deal, because it sounds like, between due diligence and then financing and the timeline here, you had some interesting things pop up. Let's go over the basics. Like, tell us the structure of the senior debt.
Sure. So initially, the broker actually lined up financing with a local bank for whoever bought the deal, and he marketed it with that as essentially a staple. The bank ended up, so that loan that we initially, based our bid and underwriting on was $2.6 million, which is about 74% LTV, 5.65 interest rate, which at the time was pretty competitive. 1 year IO, 25-year AM, and a 5-year term. So we bid based on that, and then probably 3 or 4 weeks into due diligence, well, I guess 3 or 4 weeks after we signed the LOI, so a couple weeks into due diligence, the bank ended up retrading us pretty severely on all those terms. What we ended up closing with was 1.8 million at close and a $500,000 credit line. So the total, compared to the 2.6 was 2.3. So we lost 300 grand there. And then also the credit line, you don't get the benefit of the closing, right? So we had to raise a little more equity to kind of float that while we waited on our loan draws. Our final interest rate was 6.35% fixed for 5 years, 1 year IO and 25-year AM.
Okay. And then did that impact or cause you to retrade a little bit on this deal?
It did, yeah. So everybody that bid on this deal, we assumed used the financing that the broker had presented because it was better than most other options at the time. So we felt that was a pretty understandable reason to adjust the purchase price, considering that, if they'd gone back out, everybody would have seen the new terms and probably changed their price as well. So we came back and proposed 3.2 million rather than 3.5 that we'd initially offered. They countered at 3.25 and we accepted.
Got it. Is there any lockout periods or prepayment penalties on this debt?
No.
And did you guys, was there a need to get an interest rate cap?
No, so it was fixed. We,
Okay.
so far, we have only used fixed rate debt. We're exploring now whether, doing a floating rate loan with caps makes sense, considering that rates have already come up, but we don't like to take the risk of that. I mean, we've seen, a lot of people run into issues so far this year and last year with floating rate loans that have in some cases doubled or even more since they closed. And it's just our goal in our underwriting is to minimize the unknowns as much as possible, because there's always going to be unknowns, and we want to, limit those as much as we can so that we can really focus on sensitizing our analysis around the ones that we can't, know for sure. And it's pretty easy for us to just go to fixed rate there. The one challenge is if you do bank debt, right, which we've done on both of our deals so far, you get the benefit of fixed rate without having to deal with prepay most of the time, but it's full recourse. So we'll probably have to end up doing agency financing at some point, depending on, once we scale up on our deal sizes, just because my partner and I personally guaranteed this one, and we won't be able to do that forever on full recourse debt.
Got it. Awesome. Thank you for sharing. Well, let's talk about, you did raise capital in this deal. Let's talk about, the total raise. What did you bring? What did your limited partners bring? How did you structure this? Also with it sounded like there's another general partner in the mix. How did you structure that side of the deal too?
Yeah, so the equity raise I mentioned earlier is about $2 million total. That was for the down payment, but then also we raised about $250,000 for our renovation budget. Our total renovation budget was $750,000. We had a $5,000 credit line, and we raised the rest. $600,000 of that came from the 1031 proceeds from our first deal where we exited in January, and then the other 1.4 came from new investors. My contribution and my partner's contribution were part of the 1031. So we had money in that deal, which we rolled into this one, and that was our contribution to the deal on the equity side. And then as far as the structure and fees, we charge a 2% acquisition fee, 2% asset management fee on monthly effective gross income, a 1% disposition fee, and then a 30-70 split above a 7% IRR, and a 50-50 split above a 16% IRR.
Okay, awesome. Well, I feel like we've covered pretty much everything in detail. I have a couple questions though for you in wrapping up. What did you find that was easy during the process that you thought was going to be challenging? And then conversely, what did you think was going to be more challenging that actually ended up being easier?
Sure. So I guess starting with what we thought would be easy and ended up being challenging. On this one, it's got to be the debt. I mean, the debt process is not usually easy, especially on smaller deals like this with a local bank. I think we were probably the first real, syndication they'd ever done. But we had debt that we thought was committed when we bid because the broker had already lined it up. We thought that was going to be easier than it normally would because we didn't have to go find it on our own. Turns out that wasn't the case. We ended up, like I said, we got retraded on terms. We also wanted to make sure we had the debt committed before our due diligence period expired. And we were supposed to get a commitment letter, I think, mid-December. We ended up getting it in mid-January, like 2 days before our due diligence expired. So that was a little bit of a nail biter. But that's probably the biggest thing that surprised us in terms of how difficult it would be. And then what we thought would be hard that was easy, I'd say it's actually more post-closing. The renovations have been a lot cheaper and more efficient than we maybe expected. We had one issue on the first one where we had a painter that just never showed up, but that cost us a couple of days, and we got a new painter in there who's great, who's done all of our units so far. And we tested out the market on the first unit so I mentioned earlier, one tenant moved out the week before closing. That actually worked out pretty well for us because we got a credit at closing for it not being rent ready. And then we were able to renovate it immediately and get it leased up and kind of prove out our target rents. So we budgeted about $17,000 on average per unit. That first one, we decided to test out not replacing the cabinets and the countertops and just doing paint, flooring, and appliances and lights and doorknobs, that sort of thing. And we ended up renting it for about $100 more than we had actually budgeted. So that gave us the confidence to continue doing the same sort of renovation on the rest. And cabinets and countertops were the most expensive single thing we were planning on doing to these units, other than I guess flooring. So that cut a lot off our renovation budget right there. And we've now got a good team. We've got a painter, a flooring group, and a group that puts in the kits and does the cleaning. And it's kind of like clockwork at this point. We just did 8 units over the last couple of weeks, and it was very smooth. So I'd say that was probably the biggest surprise in terms of not being as challenging as we expected.
So you and I were chit-chatting before the show, and there's an obstacle that you did bring up that we really didn't touch on. I think we kind of glossed over it, that I think is worthwhile us talking before we wrap up today. And that is the timing of the deal and how this all went down. So, you closed in February, it's under contract in November, you're doing all the stuff around the holidays, like, Thanksgiving, December with Christmas and Hanukkah, right? And everything. Like, what are some words or some thoughts that you can share with people around timing of deal closings?
Sure. So it was kind of a running joke at the private equity firm where I met my business partner, that we always worked through Thanksgiving, and we never won the deal we were working on during Thanksgiving. But the idea behind that was everybody else is taking time off. And if you got a deal that looks attractive, you're probably competing with fewer people, and you're probably going to be able to move faster than a lot of people you're competing with. So that's actually a good time if you're willing to work through those holidays to get deals done. But it does create challenges, and it creates challenges around it's not just our time, right? It's the fact that the lender is not as incentivized as we are. The investors aren't. I mean, no one's really as incentivized as the GP to put that time during the holidays. So you've got to wait for the property management company to be available for your unit walks. You've got to wait for the lender's investment committee to meet after the holidays, right? And so it definitely, I mentioned we built that in a little bit with the timing in the PSA, but it definitely delayed the process. I think another really important piece of this deal timing wise was that we were trying to line up a 1031 with another deal that we syndicated. So that was, it worked out. I don't know if you'd asked me when we first signed both of those, what I thought the probability was of the timing working out. I'm not sure what I would have said, but it ended up working out. We closed the exit about 2 weeks before we closed this acquisition. And at the time, my business partner and I were both still working full time. We're now doing this full time, but we hadn't really done any marketing to raise money until this, besides just sending our decks to the investors in our network. And we weren't sure if we could raise the entire $2 million if we didn't have that $600,000 from the 1031. Now that would be an easy raise for us, but at the time, with no marketing, we just weren't sure. And so it was pretty important to us to line that up. And that just complicated it further with the holidays, but it ended up working out. I'd say as far as advice around that, it's just make sure you take it into consideration. If we had gone in and put a more typical timeline in our PSA, maybe like 30 days due diligence, 30 days to close, we wouldn't hit it, right? Because of the holidays. So you just got to make sure you understand what is coming up during your due diligence period and your closing timeline and plan for it ahead of time.
Nice words of wisdom there. Thank you for sharing. Well, Mac, thank you for spending your time with us here today, sharing your knowledge and expertise. If people want to find out more about you and connect with you, how can they do so? So
we are on LinkedIn. Sweet Bay Capital is our page name. And then you can also check us out on our website, which is www.sweetbay-capital.com.
Awesome. Well, again, Mac, thank you so much for sharing your time with us here today. And we look forward to hearing about future deals.
Of course. Thanks for having me.